David, we're about 50%. Do you think we should start?
Yeah, go ahead.
Awesome. Like I said, my name's Chuck Evans and David Tinsley. We're with Lenders Cooperative. Welcome to our 30 at Noon webinar series. This series is designed not to replace the trainings that you have at NADCO or NAGGL or even the SBA. What we like to do is to bring you industry stakeholders that are well respected in their fields and share some of their experiences and some tips on how to do things going forward. Today, we are very fortunate to have my friend Edith Wiseman from FranData. Edith has been with FranData for 24 years.
Plus.
Less plus. And here I thought you were just a puppy. Anyway, welcome all. We're going to talk about the future of franchise lending. And David, any questions, burning questions that you have before we start?
No, but I would bring up, so we have the Q&A that's set up as part of the session. So any questions, I'll be monitoring those as we go. Just put if I'll be happy to interrupt as we're going, especially if it's really pertinent to what we were just discussing. So I'll monitor those the whole time. Feel free to drop in questions there.
Okay. And this usually takes about 40 minutes. I know we say it's 30 at noon, but that's just catchy. So stay tuned for us for about 45 minutes. I do want to tell you a story before we start. When I was introduced to FranData several years ago, I've been a lender service provider for a while. I had a client that started in franchise lending, and they started looking at a burger franchise. And they financed or committed to finance 4 or 5 of those. Maybe a month later, I was at one of the conferences, and Paul, who works for Edith, said, Chuck, stay away from that franchise. And sure enough, it was caused problems. I immediately went out and got a subscription to FranData. So when my clients come to see us, we want to make sure we give them all the right information. And today, you're going to learn a little bit about that. So Edith, I'm going to turn it over to you.
Yeah, thank you, Chuck.
You're welcome.
I thought it would be helpful to kind of start our discussion with looking at what 2025 is going to look like for franchising. The IFA, the International Franchise Association, every year, in conjunction with FranData, put out a forecast for franchising. And so overall, it's a very good news story. There's a significant amount of optimism around franchise growth, projecting about 20,000 new franchised units in 2025. There is the ability here on this slide, if you can see my screen, for you to download the whole report. It's quite thick, so I'm only going to touch on a few little highlights. If you have specific industries, I'm going to go over what are the top growth industries, but every single one of the industries are covered in this report. I will say that having just come back from the IFA convention and talking to franchise development folks, there's unbelievable optimism. Pipelines are very strong. Closures in January were also very strong. There is some word that perhaps there was a slowdown at the end of the year due to the presidential cycle. A lot of people not quite willing to commit until they know what the future looks like in terms of leadership. But that being said, it's a good news growth story for franchising, outpacing GDP growth by 5.4%. By 5%. So it's a good news story. When we delve into the individual categories, what you see, these are kind of the top industry categories where we're going to see some growth. Number one is personal services. So as I like to say, we like to take care of ourselves in some form or fashion, and the Wellness 2.0 has really driven growth from a new brand perspective in our database. So think things like red light therapy, cold plunge, sauna, you name it. We're seeing a lot of new brands and a lot of growth in those sectors. And we always consistently see growth in food. So you can see in 2025, we're projecting a 2.2% growth in quick service restaurants. Notice sit-down restaurants is not on this this list.
Yeah. Personal services, though, that's a big one.
Yes, that is being fueled, I'd say, both by new services coming to market,
Okay.
plus also just the growth in the existing business lines across all of the personal services categories.
Just a quick question, Edith. Are they emerging brands or are they established, these new ones for this growth, would you say?
Across the board, right?
Okay, all
So, what I think has happened in franchising overall is that the ecosystem supporting franchise is unbelievably developed, right? So if you think about a new franchisor that comes to market, there's so many services to help them gain traction and to grow that didn't exist before. Outsourced organizations, but also on the larger brand side, they traditionally are able to generate more franchise development just by sheer brand recognition. So they're going to get natural kind of organic growth because people know the brand, right? Like everybody knows Serve Pro. So, if you're interested in buying a new business in restoration, you're going to go to the businesses that you may have already seen out in your own market.
How about let's go back to the emerging brands for a second. Are you seeing more lenders becoming more active in that space?
So I think that lenders are given a lot of opportunity around emerging brands, and every lender kind of has a different comfort level around their willingness to lend to an emerging brand. But many lenders put kind of a cap on how much they're willing to lend to any given brand before there's a provenness to them. And it also depends on the deal size, right? So if it's a smaller loan, the risk assessment is different than a very large loan with a brand new brand. So that's where information is critical, right? Information is critical, especially with a smaller brand with not being geographically necessarily proven out.
Great, thank you.
Yeah. So, so that's kind of lays the foundation. When it comes to SBA lending, many lenders have previously kind of used SBA public data as a benchmark for how a franchise brand is performing. And typically what we've seen is about 20+% of the portfolio of SBA in any given year represents franchise lending. Now, we've always known this amount to be underreported. So consistently, like we've done reports with brands who will say, only half of the loans that SBA did are listed in the portfolio. So there definitely has always been some level of underreporting. But since May of 2023, we've seen that drop by a number of lenders who are just choosing not to report anymore. So it dropped to, in 2024, to 13%. So that's not because all of a sudden, lenders aren't doing franchise deals. They're just, there's just fewer lenders who are reporting on the loans that they have financed. So what's interesting is that basically the 80-20 rule really applies in SBA lending relative to franchise. So, but here what you can see is 74% of, 10%, the top 10% of lenders are doing 74% of all the franchise loan volume. When you go further, the top 20% are doing 80% of the loans, right? So it's really concentrated in the top 10% of SBA lenders doing franchise deals. So what that means is, from an understanding of the franchise market, you as a lender, you basically can figure out who is comfortable with franchising. From a franchisor perspective, what it means is that 60% of all the SBA franchise loans are being done by lenders who use FranData's franchise credit score. And this is, and basically those banks have over 5 trillion in assets. So they're banks of all sizes, but they happen to be very focused and comfortable with franchise lending.
Question, Edith, if I'm a new community bank and I want to dip my feet into franchise lending, how would you do that?
So you're a community bank, and can you give me a little more detail? What's your geographic
Geographic footprint of Georgia, let's say.
Okay. Yeah, so Georgia's a great state. First of all, there's a lot of franchise activity in Georgia. In Atlanta in particular, I talked to the Chamber of Commerce there, and they wanted to be called the franchise headquarters of the United States, because there are so many franchisors that are headquartered. Now, one of the challenges for a community bank is that if a franchisor is nationwide, then they're going to want to have a relationship with the franchisor, a bank that can help nationwide. That being said, some franchisors are structured differently, right? So some franchisors have mid-tier people who are responsible for just one area. So if you think like Orange Theory Fitness, they've got a regional rep that is in charge of specific areas. So those working with someone like FranData to identify who those people are in order to create relationships with the people who are actually in that local market. It's also about proving yourself with one franchisee. So the benefit of franchising is that if as a lender, you can establish a name for yourself. And basically, if you've financed one franchisee in a brand, that is enough to have you have a conversation with the franchisor, who then can validate that they had a good experience. And then they're more often willing to put you on, say, a lender list, and to think of you for deals in that market.
So if I take a takeaway, if I can offer a consistent delivery system where I'm responsive to the franchisor and I do my homework, then this could be something that's possible.
Absolutely. Though what franchisors don't want is a lender who's going to make the process difficult.
Okay, yeah.
And then there are franchisors who have come to me and say, we will never, ever work with that bank again, because they didn't know what they were doing. They were asking questions that were irrelevant. They made the process slow, and yeah, so consistency in the delivery is crucial.
Thank you.
So I think one of the things that Chuck, you and I have discussed before is some lenders might be concerned about, gosh, the franchise directory went away, and what do we do? So I think there's 2 things I want to share. One is solutions for that, and then also just point out that issues that lenders have brought to our attention in the recent past, just as an education of what to look out for. So for one, when you come across a brand that is not on the franchise, when you come across a franchise that you've never worked before, FranData has created a certification of SBA eligibility for franchise lending that a franchisor signs. And this document is put into the franchisor's account on the franchise registry in the tab called Other Documents. And what this does is it's a self-certification where the franchisor is basically agreeing that they comply with all of the SBA eligibility rules. I'm going to show examples in a moment of how this has been expanded, because there are certain things that are prompts that the lender needs to do something. But before I get into that, let me just go over a couple of things that have just popped up recently as issues that a lender, I think lenders would benefit from knowing. So we had a CDC and a bank made a loan to a franchisor to a franchisee where the franchisee owned the real estate. And the franchisee was distressed, and they had an offer from a competitor to buy the real estate, not to buy the functioning business, but to buy the real estate and the assets. And basically they were unable to do so. The franchisor said that is not allowed. And so the response from the CDC was that the franchisor's action clearly presents a threat to the ability of SBA to maximize recovery of a troubled asset. Well, what they didn't realize is that the franchisor basically says that the franchisee cannot sell the assets of the business without the franchisor's prior written consent. I think generally speaking, what lenders should know is that a franchisor would never, under very rare circumstances, would they allow the sale of any of the assets or business to a competitor. So just, of course, that's going to be the person who's going to be willing to pay the highest dollar for that location to unseat a competitor. But control of that real estate is going to be numero uno for the franchisor. So I think knowing that in advance is really important. I did one time. What'd you say?
That's the key, knowing in advance.
That's
before
right.
it gets to this point. Yep.
Campgrounds of America, I did see in their agreement, they actually have a provision that says that a franchisee could sell to a competitor, but then they would owe royalties to Campgrounds of America. But generally speaking, that would not be something that you could plan as a recovery for the assets. The other thing is when a lender is underwriting a loan against say equipment, where the equipment is proprietary or it's branded, right? So most of the franchisors carve out branded products as theirs. And so you just have to know that whether or not that collateral is actually yours or if that's the franchisor's. I looked at one franchisor where the proprietary equipment would be 18% of the loan proceeds would be for that proprietary equipment. And so you just need, like, having a perfected security interest on those proprietary items may be problematic. So you have to make sure that you clarify what is branded, and whether that branded equipment the franchisor has rights to and you don't.
Yes, I've got a question. You may be touched on this as we continue further, but it's sort of a two-parter if you got a second.
Yeah.
The first part is, how do lenders learn about franchises that are supportive of both lender and borrower? Is there any kind of way that you go about providing that?
Can you say that one more time?
Yeah, how do lenders learn about franchises that are supportive of both the lender and the borrower?
So that's a big question. I'm not sure exactly what supportive means. I'd say in rare circumstances, a franchisor, if they're trying to do a program with a lender to say, ensure that a certain type of equipment is upgraded or renovations are made, they might be supportive in a meaningful way, meaning that they're going to maybe backstop a certain amount of loans, put together a guarantee pool. When you think about, there's supportive, there's some certain franchise brands that actually have hired internal people to help franchisees get financing. So like there's someone responsible for that. I would say that typically only happens when a franchisor, when the cost of the franchise is significant. And so it's a more complicated loan process, and there's a lot of development happening. I'd say that another way to know that a franchisor is supportive of their franchisees in financing is, this is going to sound a little self-serving, but if they are a franchise registry member and they have a signed certification and they know their credit score, and you can have a dialogue with the franchisor about their credit score to say, okay, like I see that in 2020, you lost a lot of locations, like what happened? And to be able to, for the lender to be able to have that conversation. But I'd say the first thing is to know, are they a franchise registry member, and do they make these tools available to you as a lender to be able to help their franchisees, and to help you in their assessing the risk of their franchisees and franchise opportunity.
Edith, in a couple cases where the franchisor realizes that the franchisee's not going to work or not going to make it, some of the really good ones will bring in a new franchisee. Am I right?
That's right.
And
And
that helps the lender, certainly.
Right.
it does.
So let me do a follow-up. And so what are franchisors doing to ensure a clear approach for SBA loans that might be looking for additional information that's not readily obvious in the documentation that the franchisor normally provides? I know that's open-ended as well, but any thoughts there?
Say the first part of that. I feel like my aging ears are just not working.
So what are franchisors doing that you see, all right, to help ensure a clear approach for SBA loans?
So a lot of brands actually work with outsourced finance brokers. And so they're trying to say, like, this isn't our area of expertise, so we're going to work with someone else who can help guide them through the process. So I think other ways franchisors are kind of credit scoring franchisees before they get to the bank. In the fund report, we specifically share what the qualification criteria are of the franchisees that the bank is, the franchisor is looking for. To me, that's super helpful for a lender, because you know, like the quality, financial quality of a franchisee that would be coming to you, or that should be coming to you. And then if there's any additional requirements, right? Like I know some lenders don't want to finance a plumbing business unless it's a plumber, right? But many franchisors won't require someone to be a plumber as long as they can hire a plumber. So knowing upfront that what those criterion are can be very helpful for for you as a lender to evaluate the franchise, but then also to kind of ask the franchisor about, like, why did you set your criteria this way? Is it just to help because you know that this is what's going to help them qualify for an SBA loan? Because honestly, sometimes that's the justification.
Sure. I mean, I can think of several times just in previous experiences I can go with that you might qualify as a franchisee, but the lender's going to struggle, to your point.
Mm-hmm.
You know, that obviously is not productive either.
Okay.
Any other questions? So,
Thanks.
whoop.
Sure.
It's not my screen sharing. Give me 1 second. I will
That's
share.
fine. Timing's good. I've got an extra one there for you. I think maybe this might have, I don't know, I might ask for clarification on the question here, but it's around, can a borrower get an SBA loan to buy into a franchise versus acquiring a franchise?
Can they get an SBA loan to start up a new franchise?
That's what I maybe if the person who answered the question can clarify, because I don't know if that's a partial change of ownership type question. You know,
Sounds like it.
buying into a franchise, or is the question
Sounds like it. Yeah.
buying into a franchisee? Either one. Start a new franchise. Yeah, that's the intention.
So I think that's a better question for you if it's a partial change of ownership.
No. So the question is to start a new franchise.
Oh, yeah.
Okay.
There's a lot of, some lenders only want to do business acquisitions, or they only want to do loans with real estate. But there are plenty of lenders who are willing to do startup-based projection lending. With that requires a lender to have more information about benchmarking those projections against what's actually possible. So it's really helpful to a lender to have benchmarks. So let's say if someone's going into a plumbing business, to see, okay, let me look at 4 or 5 different plumbing franchises, see how they're performing. How is this brand's franchise performing? To then benchmark, is this unrealistic, right? Like if you think about David and Chuck, you guys go back to the Huntington Learning Center days where the government got involved and did a report. The lender was basically taking projections that were wildly high and unattainable based on what Huntington Learning Center's franchisees actually generated. And they were just kind of rubber stamping based on these unrealistic projections. So there were a lot of failures. So that's why I say that doing startup lending, there are lots of lenders who are comfortable doing it with franchises, but having some benchmarks to have a reality check is really critical.
Thank you.
Okay, well now I'll get to the revisions on the certification that were made this past year. So what you see here on the screen is a checkbox. So a franchisor, there's been, I want to say 5 checkboxes added to the certification. And these are prompts for the lender to know that something else needs to be done. So for instance, what was added is a franchisor has a form subordination document that it will execute upon request that does not include attornment and non-disturbance language. So the franchisor, if they check this box, says, yes, we have a form subordination document. Great. Don't you want to get that up front as early as possible to know? So that's a really helpful tool for lenders. Another checkbox is management agreements. So this comes under the passive, SBA doesn't want franchisee, anybody running a passive business. There was a SBA lender conference that we went to where there was I'd say a little fear mongering going on because there was a business that was being described as a franchise. To be clear, it was not a franchise, it was a license. And the business was putting in water distribution equipment. And essentially the licensee was not putting that equipment in. It was not their responsibility to put it where it was going to be held. So like where the real estate. And then it also was not the franchisee didn't collect any money. It just went straight to the licensee. So basically the licensor stopped paying and the licensee couldn't pay the loan. And it turns out that much of the equipment was actually never even put where it was supposed to. So anyway, this brought up the issue of passive business ownership. And SBA only finances active businesses. So management agreements become problematic if the owner is not involved in some of the key decisions that an active business owner would have over budgets, over hiring and firing, etc. So we added this checkbox because a management agreement always needs to be vetted.
Yes.
Because that management agreement could make the business passive, even if the franchisee might have an option to not use the management agreement, right? So it may be that a franchise in one instance is eligible and in the other instance isn't. So that's why we made that prompt.
This is good.
There are some others, but I didn't want to go through every single example today. But as a lender, you guys can all log into the franchise registry. Let me pick a random brand who has a certification. Primrose, Goddard, Kitty Academy.
Those are good ones.
You could look up any of those brands and look at the certifications. Okay, so whenever you think about franchise lending, you think about two things. One is, are they eligible? And then the second is, are they credit worthy? And so we have made a study of evaluating the credit risk within franchise systems. And what you can see here is the scale. And the scale goes up to 950. So it's similar to a FICO score. And it can go as low as, I think I've seen it 200. So don't do the 200. Or if you do the 200, be very cautious. So what this entails is that we're looking at success rates of the franchisor over a 5 to 8 year period. We do not credit score emerging brands. What we do for emerging brands is we basically do more of a benchmarking to say, like, if this franchisor continues to perform the way they are today, then where would they fit into this credit scoring model? And we can only do that if the franchisor has at least 5 locations and has been franchising for 3 years. So basically, your first time franchisee with a franchisor is going to be 100% dependent on that individual. There is nothing to credit risk other than having an understanding of that, if there are any corporate locations, how the corporate locations perform.
Question for both of you. So if I'm a community lender, am I going to shy away, and I'm new at franchise lending, am I going to shy away from the emerging brands, which may have more opportunities, but focus on the ones that have 50 stores or more, that have a FUD report? Is that a fair?
So I'm happy to share. I don't think you necessarily want to shy away from good deals.
No,
right?
You're right.
So, you know, if you have a strong, so I'll give you, for instance, my cousin and her partner are basically first-time franchisees with a brand that has 1 location in Asheville. And but that particular deal is a great deal. The partner owns a technology business, very sophisticated, veteran, you know, financially qualified. You know, this is not this is not someone who just, so like, to me, it's you don't want to shy away from good deals and good businesses, because every franchise that has 1,000 units started off at one point with one.
Okay, that's good. Thank you.
But I do think that you do have to bring a level of cautiousness, and that's when I said you need to have more information to make sure you feel confident that this loan has a high likelihood to succeed.
Thank you.
David, did you have a perspective on it?
Well, I basically to agree with you when I say that, because I mean, I would treat that very similar to the way we would any kind of startup that's not a franchise. The difference is you're going to have the added element of how does that relationship impact that location, you know, that business, because you want to make sure again, it's almost in that case. I would think that the relationship with the franchisor only serves as an opportunity to be a detriment, not necessarily. You don't have enough to establish it as a positive just yet. And so to your point, Edith, it would heavily be reliant on the quality of the owners you're working with, the applicants themselves, and like their background and the character involved there. I would think that would be the greater focus that you would have as a lender, and just to make sure you're not going to be in trouble down the road as a result of the nature of the franchise relationship.
I would also have a really keen handle on how much the franchisee is required to spend on a monthly basis to
Right.
know what's going to be their cash drain. So you just don't want it to be too high to stress what they're actually capable of doing should they not get off the ground as quickly. You also have to keep in mind that different types of businesses have different ramps. You know, in your food always starts at the highest sales they're ever going to have is, you know, day one, grand opening, everybody's excited. Whereas service-based businesses, you know, it's a slow ramp.
Right.
So, factoring in those differences into the evaluation is also really important.
Thanks, guys.
So I don't shy away from emerging brands. That being said, that we do look at the executives who are a part of those brands, because in franchising, people are serial entrepreneurs. And so you might have a franchise that these people were a part of and they then move on to another franchise. And some people have bad track records, right? And so we definitely look at the management experience and where they're coming from, and whether that was a good experience or a bad experience. I think that's very important. Also, sometimes, you know, I've talked to some franchisors where I have to chuckle. You know, they saw another franchise be successful, and then they decided like, "Ooh, I could do something like that." And so they're not in it because they actually like believe in the business. It's just a copycat.
For all
So,
reasons, yeah.
you know, having founders who are really invested in the business in a way that they believe in what they're doing as a value to the consumer. So you can vet those pretty easily with a conversation.
Absolutely. Thank you.
Okay. Do you have any other questions about franchise lending or the state of franchising in general?
What about information from FranData or from Lenders Cooperative as it relates to these things? If I'm getting a subscription, or can I get a fund report? How does that work, Edith?
Yeah, so the franchise registry is open to any lender.
Mhm.
And for free, if a franchisor is a franchise registry member, it unlocks their account so that they can get access to things like the certification, the FDD, contacts, and any other documents the franchisor chooses to put into the account. And lenders, if they want to have access to the credit reports, of which there are over 700 franchise brands that are credit scored every single year, and other, and then also emerging brands. That is a separate subscription. You can either buy one at a time, which of course then the reports are more costly, or you can subscribe to the whole set, and then it's a basically all you can eat model.
Perfect. David, what do you use? Anything else that you can think of as far as evaluating franchisors or franchisees?
Is that to me, Chuck? I'm sorry it cut out.
It's okay. I was just asking if any other tools that you use as far as evaluating franchisees or franchisors?
I, I mean, to me, it's still you're always all of the things that are associated with whatever industry you're working with, all of those risks are still the same. You know, the nature of the business model, the number of employees you've got still factoring compared to a larger versus a smaller business. So in many ways, it's something that it augments the decision process. And in some ways it does give you strengths. If you have a proven model that you can point to, especially with the more established brands, I can see why that would be a comfort to the lender. You know, you can show the success rate. You can also speak to sort of geographic, how well they've done here. And I mean, there's all kinds of ways that can help add detail to the decision. So I mean, I can see why that would be very comforting. And at the same time, you know, assumptions are only as good. Well, so I should say the projections are only as good as the assumptions that go into them. So if that really helps you, if understanding where assumptions, how they were built, a lot of times I would think being able to speak directly to a franchisor in this process makes a big difference in being able to do that. I know we all make jokes about, we all get some variation. If you build it, they'll come, right? Like we see that all the time. And to some extent, I suppose all startups are that way, but being able to see consistently, these are you know, we see when this type of situation occurs in this area, in this way, here's the outcomes, you know, 95% of the time or higher, whatever you're working with, but that can go a long way toward establishing you're making a good, reasonable credit decision, which is ultimately what SBA is looking for. And your own regulators and your own internal, you know, risk committees and so on. They want to see, why did this seem like a good idea at the time? And I think that does a big difference.
That's helpful. All right. I'm the community bank. I've done my homework. I've identified some franchisee boards that I'd like to go. How do I get in touch with them?
Call FranData.
Call FranData. That's right. You have the contact information for every franchisor as far as the SBA contact. Am I right?
So we track about 4,000 franchise brands a year, 450 new. Were added to our database last year. And yes, we have executive contact details for each of them. And then we also talk about, you know, what are the pros and cons, obviously, of creating a relationship, and maybe what's the ecosystem around that franchise that would help you generate more leads, because you're not always going to get a direct relationship with a franchisor, but you can get a relationship with the ecosystem that can then help bring some deal flow for the brands that you have vetted and want to do business with.
As long as we have a consistent delivery system, right? Well, Edith, this is great. Thank you so much. When are we going to see you next? What's the next conference FranData is going to be attending?
Well, we just came back from the International Franchise Association conference. The multi-unit franchise conference is coming up. The Georgia Lenders Conference is also coming up.
In North Carolina and Cherokee. Yep.
In North Carolina. That's right. So we go to about
all of them.
13 to 15 conferences a year. So bound to see you multiple times.
Yes. And please introduce yourself if you're at one of these conferences, because this is a great resource for SBA lending. Well, thank you, guys. The next webinar is going to be, again, the third Thursday of March. And our topic's going to be getting 5 or 6 successful CDCs, SBA managers to talk about their vision for 2025 and what keeps them up at night. So stay tuned. We'll send out this PowerPoint to all the attendees, and please give us their feedback. If there's other topics that you'd like to hear from, please let us know. And thank you all. Again, thanks, Edith. Thanks, David.
My pleasure. Thanks.